bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac. This is Tax Credit Tuesday. This is the January 7th, 2025 podcast. I'd like to welcome you to our Renewable Energy Tax Refinance series with my partner, Tony Grappone. Today, as many of you know, is part 2 of our podcast on the 10 things that you, as a renewable energy developer or investor, should address with your tax account. And we covered the first 5 topics in our December 17th episode. And if you haven't listened to that episode yet, I do encourage you to go back and listen. And we discussed items in that episode that generally occur during the earlier part of the life cycle of renewable energy development. More specifically, we discussed the importance of identifying the place and service date, the various depreciation conventions to be considered, the importance of comparing actual results to the original projections, as well as assessing whether or not you need a DRO, that's a deficit restoration obligation, as well as to consider various state and local taxation. Now, this episode, we're going to cover the second 5 of our 10 issues. These are situations or occurrences likely to happen during the operating or disposition phase of a clean energy development. The 5 we're going to talk about today are assessing whether or not you have positive taxable income, assessing whether or not an ownership flips occurred, revisiting capped waterfalls, assessing any tax credit recapture events, as well as being alert to any ownership changes during the year. Now, if any of these 5 topics that I mentioned to you sound a bit cryptic, then this podcast is definitely for you, as we'll discuss the significance of each of these 5 in the course of the podcast. Now, myself, I'm pretty anxious to begin our first podcast of 2025. So if you're ready, let's get started. Tony, thanks for joining me for part 2 of this discussion, as well as bookending 2024 into 2025.
Thanks, Mike. It's great to be back. And yeah, I mean, it seems like almost a year ago where we talked about the first part of this tax series.
No, it's been a great idea. And thank you for your support of this series. I get lots of positive feedback, email and on Twitter, as well as at Bruce Copyright. And I know you do as well.
Absolutely.
And normally I will begin the podcast with a guest saying a bit about the services they provide and the rest. I think we can dispense with that. If there's a listener or viewer who is not aware of all the services you provide in the tax audit and consulting side, please go back and listen to episode 1, where the first part of this podcast, 2-part podcast series, where you went through and discussed that. Let's jump right in to the topic 6 of our list of 10. This has to do with positive taxable income. And some listeners might be thinking, positive taxable income seems like an odd topic, particularly since personal property has a rapid depreciation, even partial expensing. So normally when you think of renewable energy development, thinking of large tax losses, which is true. And really the purpose of talking about positive taxable income, as you know, is that when you have large tax losses, particularly expensing, in fact, where you can even have full expensing, you then can quickly, or at least more quickly, have positive taxable income from a given development. So Tony, if you could share with our audience the importance of assessing that, what some of the consequences are of having positive taxable income that a listener or viewer may not be aware of, or at least may not be front of mind.
Yeah, great. Thanks, Mike. Right. So you tapped into it, right? Most people think, renewable energy facilities make up, most of the depreciable assets are personal property, which are allowed to be depreciated over a very accelerated period of time. So a lot of people just naturally assume that you have high tax losses on renewable energy facilities. And while that's usually true in the very early years of operations for a facility, once you get out into years 5, 6, and beyond, most facilities start generating positive taxable income. And for investors, sponsors, and tax equity investors in these transactions, if they lose sight of that, what can happen is they can all of a sudden get surprised with unanticipated positive taxable income. And obviously, if you've got positive taxable income, that can result in tax liability payments. And then if you've got tax liability payments, it's important to estimate and pay those timely. And so you don't want to fall behind in recognizing that income sort of timely and staying in compliance with your tax obligations. So this is a great time of the year to take a look at your portfolio. A lot of sponsors and investors, they have large portfolios with lots of assets. It's a good idea to take a look at your portfolio, see where they are in the operating life cycle, and figure out if they're apt to or likely to be generating positive taxable income federally or even on the state side. And so, and with state tax compliance, it's not uncommon where state doesn't exactly mimic the tax rules of the federal government. So you can have some differences with your state and local taxable income as well. So I just like to encourage people, take a look at your portfolios, see where they are in the life cycle, and give some thought to whether or not you might have some unanticipated taxable income. And then obviously reach out to your CPA, your tax return preparer at your CPA firm, and involve them in those discussions and analysis as well.
This maybe also highlights how the concept of this two-part series podcast is the discussions you're having with your tax accountant as you begin the tax filing season. In some ways, we're thinking about this in terms of the impact on filing the tax return for 2024 for calendar year taxpayers. But it also sort of emphasizes how it's not just talking about what happened in 2024, but also what could be happening in 2025. And you really hit the nail on the head when you talked about the need for estimating tax payments. So even if 2024 doesn't have taxable income or notable taxable income, 2025 does, then the need for tax payments, starting this year kicks in, and you want to make sure that investors are aware of that. And then the other I wanted to just observe is that with the potential for a major tax bill or the likelihood of a major tax bill this year or early next year, potential for 100% expense coming back is very much a realm of very, very possible. Somebody could say highly likely, and it might even apply to assets that are going to be placed in service in 25. And certainly you would think by assets placed in service in 26 or later, such that, the expensing and the ability to get large tax deductions that first year are likely very high, which means you might have positive taxable income a lot sooner for the next year. Definitely a critical issue to be assessing and weighing as you're with existing projects as well as projections on new projects.
Yeah, Mike. And then, if you think back to when Tax Cuts and Jobs Act was originally passed, after that was passed, we helped a lot of clients kind of analyze their partnership agreements to figure out what tax law changes mean with respect to your deal terms. Some partnership agreements have provisions in them that you need to consider when tax law changes happen. And so I imagine if a significant tax bill does get passed this year, that we'll probably be going back to that again with clients and analyzing how the tax law changes impact the deal terms that apply to their facilities.
No, I appreciate you making that observation. And maybe this is the kernel of another podcast that we should have, which has to do with the fact that, there's such a high likelihood of a tax bill passing this year, early next year. Some would say a near certainty that developers that are negotiating with investors now need to be assessing what the changes are. Can they anticipate them in the agreements with their investors, as well as can they be influencing the potential for changes that could or couldn't occur, which is what the Renewable Energy Tax Credit Working Group is really focused on right now. So I would encourage those of you that like this tangent to get involved in our Renewable Energy Tax Credit Working Group. But let's get back to the topic.
Sure.
We can maybe have a follow-up podcast specifically on potential tax law changes and the impact on renewable energy transactions historically and going forward, as well as the role of the Renewable Energy Tax Credit Working Group is working to play. So the next topic has to do with ownership flips. Ownership flips. And I'd like for you, rather than me do an intro of explaining it, I'd like for you to explain what I mean when I say ownership flips. You can try to read my mind. And then discuss when they're most likely to occur and why the audience should be focused on the concept of ownership flips.
Great. Thank you. So in renewable energy project finance, probably the most commonly used structure is called a partnership flip arrangement. With the partnership flip arrangement, there's oftentimes two different types of flips you can have. And then the two different flips aren't per transaction. So either you might have one type of partnership that has flip option 1, and you might have a different partnership that has flip option number 2. Flip option 1, I'll call that a fixed flip. With a fixed flip, that basically means that the partners agree that their ownership interest will flip at a predetermined point in time, usually a very specific date. The most common example of that might be the partners agree that on the 5th anniversary of when the facility was placed in service, they agree that their ownership interest will flip. The most common flip arrangement we see is where the sponsor starts out with, say, a 1% pre-flipped interest, and the tax equity investor starts out with a 99% pre-flipped interest, and they agree that on the 5th anniversary of when the facility placed in service, their interest will flip, where the sponsor's interest will automatically flip up to as high as 95%, and the Class A investor's interest will flip down to as low as 5%. Okay? With a fixed flip, that flip almost always happens, at the end of the year on December 31st. If you're talking about a calendar year taxpayer, that flip almost always happens on December 31st. But sometimes that flip can happen mid-year based on how the deal was structured. Flip option 2 is what we call a yield-based flip. So with a yield-based flip, the flip doesn't happen at a specific point in time. It happens once the investors has reached a minimum targeted yield. And if you're talking about an ITC transaction, usually the targeted yield flip isn't allowed to be calculated until the facility has at least reached the 5th anniversary, so that they're beyond the 5-year ITC recapture period. But anyway, when you get to the 5-year anniversary when operations commenced, you do a calculation of what the investor's yield is up until that point in time. And if they've achieved their yield, then they flip. If they haven't yet hit their yield, then there's some kind of mechanism built in, like a cash flow sweep of sorts, to try to get the investor to hit their yield as quickly as possible. Regardless, what that can mean is it means that the investor might flip mid-year, not at year end. Okay. And if the investor's interest flips at mid-year, it can make things a little bit more complicated in terms of how you allocate partnership income and loss. You won't just be allocating things, call it 99-1 for the year. You can have a portion of the year where the losses or income is allocated 99-1, and then you might have another portion of the year where losses are allocated based on your post-flip sharing ratios. So you want to be mindful of when the flip occurs, and you want to keep an eye on that. And then, as we'll talk about later, once the flip happens, there can be other sort of triggering events in the partnership agreement that you need to sort of pay attention to as well.
Excellent. And closely tied to partnership flips is cash waterfall. And the cash waterfall is, as our audience, just the name describes it, it's how cash falls once you have excess cash, who gets what percentage of that cash at different points in time, as well as if more cash is available. So if you could explain some of the typical cash flow waterfalls in a renewable energy transaction and the importance of revisiting waterfalls.
Right. Great. So, when a partnership generates, I'll call it net operating income or EBITDA, the partnership agreement will have a waterfall section that says, before you make distributions of net operating cash flow, you have to pay or fund certain priorities in order. And so the waterfall section of the partnership agreement will say how the partnership is instructed to use cash to pay or fund certain items in a very specific order. So for example, when the partnership, let's say the partnership generates net operating income, the first thing it's supposed to do with that, in a classic example, is make, required principal and interest debt payments on a loan. Okay. And then after you've made required debt service payments, you might have to make a reserve funding that's required by the lender or one of the investors. After that, these tax equity partnerships oftentimes will hire an affiliate of the sponsor to provide certain services to the partnership, like asset management services, or maybe investor services, or what have you, or even development services. Anyway, these types of related party fees oftentimes get paid in a certain order based on the availability of cash flow. Okay. And then finally, after you've sort of made principal and interest payments on a loan, reserve requirement fundings, payoffs of certain related party service agreements, et cetera, then you finally get to the distribution of net operating cash flow. Okay. And one thing that we sometimes see in these transactions is a sponsor or whoever's kind of making those year-end sort of cash payments might lose sight of the ordering of which they're supposed to make these fundings. And sometimes we can see a sponsor inadvertently make a distribution of net operating cash flow before, say, paying a priority return distribution to an investor. Or maybe they paid a priority return distribution to an investor before they paid a deferred development services payment obligation off. Okay. And, once year end, once you pass year end, it's kind of, it's really hard to go back and change history. And so it's kind of what's done is done. You just kind of, you note it and you kind of move on. But one thing you don't want to do is you don't want to let, you obviously want to comply with any lending agreements and financing agreements, because sometimes there could be consequences, monetary consequences, if you don't comply with loan agreements and other types of financing arrangements. So you want to be particularly mindful there. But then in terms of like related party fees and so forth, you obviously want to make sure that you're being a good steward of your partnership and paying things in the order that the parties agree to. So the time I like to recommend sponsors in particular to, when they're in Q4, before they're making those year-end sort of payments, fundings, and distributions, look at the waterfall and try to remind yourself of the priority. And if you don't understand the waterfall, you need help assisting you with kind of interpreting it, feel free to reach out to your attorney. You reach out to us at Novogradac, and we'll be happy to talk to you some more.
Tell me, this question gets us too deep into the weeds. You can take a pass, but the cash waterfall, we've talked about the priority of cash waterfalls. Just previously, you were talking about ownership flips. Maybe you can talk about the interaction between ownership flips and cash waterfalls.
Sure. So with the flip, so once the partnership agreement flips, so say you and I are partners in a partnership and you were the Class A tax equity investor, I'm the sponsor. I flipped up to 95, you flipped down to 5. Okay. Another thing that can happen there is a call option. And I don't know if this is where you were going, so correct me if this isn't what you were thinking, but you can have a call option period that commences where I've got the right to buy you out during that time frame. Okay. And then the way we typically structure that buyout is you've got the right to sell, or I've got the right to buy your interest out at whatever the fair market value of your interest is as of that point in time. And one thing that might increase that value is a lot of times you might say in the agreement, Tony, I'll let you buy my interest, or I agree to let you buy my interest during the call option period. And the call option price amount is the fair market value of your interest plus whatever payments I still owe you, that were supposed to be paid out in the waterfall. And so let's imagine I wasn't making payments to you during the 5-year period in accordance with the waterfall. Like say I owed you priority returns, and let's say I didn't pay those priority returns to you in order, and so I still owe you priority returns. Typically when when the call option period and I have to buy you out, whatever outstanding priority returns I didn't pay you previously get added to your buyout price. It's the fair market value of your interest plus amounts that are accrued and due to you, like priority returns. Maybe you've charged me an investor services fee of some sort. And so another good reason why you want to follow the waterfall is because if I mistakenly forgot to pay you in order of the waterfall during the 5 years, I don't get away. The obligation doesn't go away. It just gets added to when I buy you out of the partnership at the end. I don't know if that's what you were thinking, or if you're thinking something else, but
no, that covers it. There's a lot to sort of unpack there, so we can move on to tax credit recapture. And you mentioned earlier how the flips generally don't happen within that 5-year period because of the tax credit recapture concerns. And I thought it would be useful if you can share with the audience what, at a high level, what some of the causes of tax credit recapture are, and why a flip within the 5-year recapture period could have adverse consequences.
Right. So when the recapture, a few things can trigger recapture. One is if you take the facility out of service, okay, that can trigger recapture. The more common recapture issue that parties worry about more are with respect to ownership changes. And so if the ownership changes by more than a third, if the profits interest changes by more than a third during the 5-year recapture period, then that can also trigger recapture. Okay. So let's imagine you're my 99% tax equity partner in the partnership, and you disposed of more than a third of your interest during that 5-year recapture period. That would trigger recapture. And so you can see scenarios where you as a tax equity investor, you might actually want to reduce your profits interest during the first 5 years, because maybe you're trying to maintain a capital account. Maybe you can't use all the tax losses or whatever. So you might actually have some kind of reduced profits interest that takes place during the first 5 years, but you want to make sure that it doesn't reduce by more than a third. Okay. And so that's something to be mindful of. But another scenario where we actually do see very de minimis amounts of recapture, but it's triggered by an ownership change, is in this example. Let's imagine I'm the sponsor and I have a 1% free flipped interest. Sponsors they've been known to sell their interest during the first 5 years. Okay. And I might sell my interest to some other party. They might buy 100% of my 1% interest. And so that can give rise to recapture of the of my share of the 1% credits. Okay. Well, it won't impact, the credits that you claim on the 99% side, but the 1% of credits that I was allocated, some or all of those credits. That's not uncommon to see in these types of transactions where the sponsor sells their interest during the 5 year period. And again, their 1% of the credits is usually it's perceived as de minimis. It doesn't usually get people too worked up over things, but that's a scenario that can and we do see in transactions. And then sort of lastly, another example of recapture that we can see is the facility gets placed in service, and maybe there was something with the installation that leads to like liquidated damages down the road. And so you place it in service, you claim credits based on the full cost of the EPC contract. Well, 6 months, 9 months down the road, you enter into some sort of settlement with your EPC. You've already filed your tax return, though, based on the original cost, pre-liquidated damages. Now you've received money back from your EPC. That may or may not lead to recapture, but it certainly can. Depending on the fact pattern, it could give rise to recapture. And
Tell our
so that's
audience, remind our audience what DPC stands for.
Thank you. Yeah. So engineering, procurement, and construction. For those of you who work in renewable energy a lot, you've probably heard that term before. If you come from maybe the real estate sector, you probably think of more the general contractor, GC, is sort of analogous with EPC in the renewable energy world.
Thank you for that. Maybe to unpack it a bit, it's originally you had a certain cost and you claim credits on a certain cost. And because of the liquidated damages, your net costs are now reduced. So you basically claim credits on some costs that ended up getting to you in essence. Even if that's not legally what's happening in essence, such that could cause a recapture. And I also want to just share a little bit more about the 1/3, because I definitely have clients sometimes that are like, why a 1/3 decrease recapture? They're sort of kind of wondering, how to look at that. And I would just say that conceptually, if you thought of yourself owning that religion development yourself, if you were to sell it, then you would have recapture and invest 20% of your over 5 years. And the one that you put in a partnership, then obviously Congress was concerned that if I put in a partnership, I had a partnership interest, could I then sell my partnership interest? And because the partnership itself doesn't dispose of the property, there's no recapture. And would putting in a partnership be a way to claim the credits and then transfer your interest? And of course, that wouldn't make sense, but that would be tax policy. So then the concept was, look, you exchange partnership interest, and that causes recapture. Then you say, well, what about the de minimis change? So the de minimis change causes recapture. So you end up with this roughly white line of 1/3, which is as long as it's not more than 1/3, it's like no harm, no foul. The moment it becomes more than a third, then that's risen to a level that the Congress and Treasury, more Treasury saw fit for there to be recap. Let's move on to our last change. And this has to do with ownership changes during. And this is definitely something that, is a little bit more of, talking to your tax return. Certainly heading into filing season, you want to make sure that any ownership changes are disclosed early in the process so that you don't end up discovering in the course of the audit or burning the tax return that causes lots of extra time spent in the rest. But maybe discuss a little bit more, the significance of ownership changes and what some of the drivers are to ownership changes given year.
Yeah, probably the big one I'm focused on here is when the call option does actually get exercised. So a lot of partnerships where the flip occurred and the call option period commenced, the sponsor bought the investor out. And a lot of times in these renewable energy partnership flip transactions, they're usually two partner partnerships. Okay. And so a partnership can only be a partnership if there's more than one partner. Okay. And so one thing that you can see sometimes is during the year, the sponsor bought out the investor. Now and it was the managing member, let's say, that bought out the investor. And now the partnership ceases to be a partnership. Well, you can have a short tax year there. And you have to at least do a tax filing reporting requirement. And it's not uncommon for us to find this out, way after it actually happened. And so it could be that maybe they missed an extension filing request, or, they owe the investor a final K-1, that sort of thing. And, maybe it also changes sort of the tax reporting for the buyer going on a go forward basis too. And the sponsor wasn't aware of that. And so this is another great time of the year to kind of look at your portfolio and just figure out, do you have any call option periods coming up this year? And what I like to recommend clients do is send us a calendar appointment request, just to say, discuss calls, discuss call options, exits, that sort of thing. And then get dates on your calendar when you think you're going to exercise those options, and maybe reminders to let us know. Because, if you're going to file a short year tax return, you're going to want to engage us to prepare that return timely. And if you need to get it extended, at least get it extended timely, that sort of thing. That's probably the big one. And then obviously, if you've got these mid-year ownership changes, kind of like I referred to earlier with flips, again, the allocations of income and loss can get a little funky there. They're a little bit more nuanced because you get like a portion of the year where they're based on pre-flip changes, pre-flipped allocation sharing ratios. Then you get the post sort of ownership change ratios. A couple other things that I think can that are worth noting here, as we're talking about deals that kind of get to the end of your ITC recapture period, and when the partnership might be generating positive taxable income. Here's another thing to note. Some partnership agreements have what's called tax equivalency payment requirements, or some people call them tax liability distribution requirements. Okay. And so what I'm referring to here is some investors will require the partnership to make a special cash flow distribution to them to cover like an anticipated tax liability payment. Okay. So like, for example, let's imagine my tax equity investor gets a priority return distribution payment of $10,000 a year. Okay. And now their share of net operating cash flow is, let's just call it $15,000. I'm sorry, 5,000. So their total cash flow they got that year, priority return plus net operating cash flow, is 15 grand. Okay. Now let's imagine I allocated them $100,000 of positive taxable income. That's not the cash they got, but that was the amount of income that showed up on their K-1, and they're a corporate taxpayer in the 21 corporate tax bracket. So it suggests that they're going to have a tax bill that year of $21,000, right? So they're going to have a tax bill of $21,000. However, the partnership only distributed them, say, 15, 10 of priority return and 5 of net operating cash flow. This concept of a tax equivalency payment or a tax liability distribution payment is meant to mean that the partnership is supposed to distribute the partner an additional $6,000 worth of cash, so they have enough cash to at least pay their tax bill. That's another thing. So as partnerships get into this kind of year 5, year 6 stage of life, that's when a lot of times these tax equivalency payments can become applicable. And so again, look at your portfolio, look ahead. Where are you in the life cycle? Could tax equivalency payments be an issue this year? Okay. And you might want to get that on your radar, because if you're the sponsor, if you don't have this on your radar, you may be budgeting a certain amount of cash flow for yourself this year, but you may not realize that you might have to share more of that with your investor as part of a tax equivalency payment obligation.
Excellent. So thank you for that, Tony. And there's obviously a lot more we can be talking about, but I think I'll bring this episode to a close. And just remind our audience, on this episode, we discussed the significance of positive taxable income and having to assess that price through tax payment or even tax equivalency payments. We talked about the importance of monitoring ownership flips, as well as the priorities involved in the cash flow waterfalls, assessing tax credit recapture with a mind towards the transfer of partnership interests, as well as ownership changes during the year. And our episode at the end of last year had 5 items as well, focusing on the place and service date, price depreciation conventions, the importance of preparing actual results and projections, assessing when that can be the debt service ratio obligation, as well as being mindful of state and local tax issues. And as I noted earlier, if you did miss the first half of our top 10 list, please go back and listen or watch December 7th episode of the podcast. I would also encourage our audience to bookmark and revisit two-part episode every year. And in some ways, I'm wondering maybe we should have rebranded this, not just things to talk about with your tax at the beginning of the tax season, but also with respect to 2024, but also things to discuss with your tax account before the beginning of the next calendar year. It's a good reminder of a number of key operating issues that obviously have a tax. And with that, let me also encourage you to check out the rest of our renewable energy tax credit finance series. As you likely know, it's at novogradac.com/podcast, also on Apple Podcasts, Spotify. If you're watching us, then it's on YouTube video. And I'd also note on YouTube, we do have a dedicated playlist for the Renewable Energy series. And it's something that you can binge watch. Or if you have new staff joining, I encourage you to have them binge watch the episodes. And as always, if you have any questions or suggestions or ideas for future episodes, please email us at cpas@novogradac.com. So with that, I would like to turn now to our Up Mic section. And this is a fun segment that was inaugurated by Tony Grappone. It was his idea, where we get to acknowledge our industry colleagues with shout outs. So Tony, what is your first industry shout out for 2025? I feel like we're going to route Pine Magazine's Person of the Year.
There you go. Okay. So I love doing the industry shout outs. I'm going to take a little bit of a different approach this time. It's the first renewable energy project finance podcast of the year. And so I'm going to start off by giving a shout out just to 2025 and the future and turning the page and looking ahead. Okay. And maybe not so much an industry shout out, but shout out to Billy Joel, who once said, "The good old days weren't always good, and tomorrow ain't as bad as it seems." Okay. So seems appropriate as we look ahead to the next year. I'm excited about it. And I know you are too, Mike.
Yes, I am. I'm very excited. Thank you for that shout out. Now our audience knows why I was saying it's going to give me a little bit more of my Time Magazine Person of the Year, which wasn't always persons. Thank you, Tony. And to our audience, I'm Mike Novogradac. Thanks for listening and thanks for watching.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.